You know, somebody asked me the other day on Twitter, do I regret losing $3.5 million trying to trade the meme stock conglomerate and basket, which is the most risky stocks and securities on the planet? And the answer is no. The information that we gathered along the way was much too valuable. In this video, we are going to discuss how these stocks move, how buying pressure doesn't always lead to bullish price action, how the derivatives market works behind the scenes with fail to deliver, swaps, and options, and allows and justifies BlackRock's repeating fractal in order to consistently and distributively move these stocks lower week after week, month after month. But first, let me show you this ridiculous snowstorm that is currently outside my window. Usually you can see the New York City skyline out there, but it is completely clouded out. This is probably going to get so much worse. Since the June 2021 top, AMC Common is now down 99.64%. It has been 1,695 business days with zero supply grab price action on your super macro supply levels. We track the off exchange volume every single day. Over 65% of both AMC and GameStop's volume is traded off exchange into an alternative trading system, otherwise known as a dark pool. What I've also noticed over the last 4 years is more selling volume is allowed to hit the lit exchange as opposed to buying volume as a whole. Since the January 2021 top of the beginning and end of GameStop's 18,000% squeeze, GameStop has dropped up to 91.85% in total. The next major price action squeeze move that we had after this was when BlackRock reactivated Roaring Kitty's account, allowing mainstream media to speak about his comeback, as opposed to the Charles Schwab and TD merger, in which swap risk and derivatives risk had to be rolled as new counterparties were created under the Charles Schwab risk management profile. This was hands down the reason for your 558% squeeze on GameStop and 400 on AMC. So how do these stocks move? With a repeating, pre-programmed, pre-calculated mathematical equation which forms itself in geometry in the shape of a fractal. These fractals repeat on every single time frame, all the way from the 1 second chart to the 1 month chart and beyond. Each moment in time where buying or selling volume is rotated and injected from a dark pool ATS onto the New York Stock Exchange, that moment is called a POI, or a point of interest. The system that I built calculates, anticipates, and gives you a general sense of where the window of the next major micro, macro, and super macro POIs are. Micro can move a stock up to 50%, macro can move a stock up to 200%, super macro can move a stock up to 10,000%. The larger the time frame, the larger the percentage move within each fractal's repeating POI locations. Now, simply put, in structure, what is a POI? A POI is a flip in between accumulation and distribution. So if this is what an accumulation schematic looks like, and this is what a distribution schematic looks like, your major pressure point POI locations for volume and price action is right here. Because what you have to remember is accumulation connects into distribution like a puzzle piece, and then it repeats over and over again, infinitely through time. BlackRock's algorithm will deem this area of having too high selling supply, and this area having too high buying demand. The algorithm will then bounce price action and price discovery between the areas that have the highest demand and buying volume, and once it marks up into a selling space where supply and selling pressure is too high, it will then accumulate and then distribute back into your accumulation schematic just to start the process all over again. If you know where these flip points are and you can trade them using complex option strategies, you will never lose $1 again in the market. Now, one thing people get confused about, and it's been a topic of ongoing conflict and conversation all throughout Twitter, is how derivatives actually affect the market. Like how options are actually moving AMC and GameStop sometimes, when other times the options chain is plush and nothing ever happens price action and price discovery wise. Also, in the swaps market, which has the most loopholes, how they're bundling shorts to be masked as swaps, total return swaps, bullet swaps. And those can act as share locates. Those can act as ways for firms to hide their shorts on top of the addition of collateralized loan obligations in order to basically naked short AMC or GameStop down to a near infinite amount without any regulatory consequences. Additionally, you have the fail to deliver fiasco, which is when you buy a stock, the seller on the opposite side, you're dealing with the market maker, and the dealer is at the end of that taking on the risk. But the seller that's supposed to actually deliver that share to you fails to deliver it to you in T+1. The market maker in practice delivers you an IOU on paper so your trade gets filled, but you don't actually receive that sell order in real time. One thing people don't understand about fail to delivers is when that sell is not delivered to the buyer, that sell is put in a fail to deliver bucket, which is then unleashed onto the New York Stock Exchange at a later point in time on a POI. That is why one of the reasons functionally you see in the market how it is stairs up, elevator down, because they make sure once they collect enough sell orders and they hit the market all at once, it acts as a cascade waterfall effect, which leads to aggressive dealer delta hedging to the downside, amplifying selling pressure to a demand zone where there is more price discovery. So enough of the chit chat. I know you're excited. Let's jump into the charts. Now, any asset class on any security, it doesn't matter which asset class it is, behaves in very similar ways. And this is based off Fibonacci. Both your Fibonacci retracements and Fibonacci extensions are percentage based, allotted in future moments in time. Any new company which debuts on the New York Stock Exchange with an IPO is pre-programmed and designed with these Fibonacci protocols and controlled via BlackRock's repeating algorithm. It doesn't take Fibonacci 101 common sense to understand that when you are in a structure that has had this much distribution volume over the course of 4 years, that it is going to retrace to your golden pocket on your retracement side. I figured out in 2021 that there was not enough naked shorting power in order to push the stock down organically over and over again. So they had to tether the S&P's repeating algorithm alongside AMC and GME's to keep them from exploding higher with the ridiculous amount of buying pressure that was hitting the tape every single day in the billions. So anytime you watch the S&P make a downswing, and it doesn't matter what time frame it is, if it's micro or macro, AMC followed. They used the S&P as a counterweight to pull down AMC and cap any single run that hits on a POI based off fail to delivers or swap rollover dates. This allows institutions to come in and also cap the runs via aggressive call writing in these areas, leading to amplified dealer delta hedging, which pushes the stocks down even more than they were originally supposed to be dropped. Each macro and super macro drop was anywhere in between the 30 and 90 percentile range. And you could simply clock that just by measuring the aggressive distribution percentages on each squeeze move that happened along the narrative storyline that we have been spoon-fed based off dilution and convergence and reverse splits. One of the best calls I ever made in my history of tracking these stocks was letting everybody know that this was not a legitimate markup sequence. This was just another last point of supply grab while you continued super macro distribution all the way to your next golden pocket. The tethering of the S&P repeating fractal to coincide with AMC's is the only way they were able to drop it 99.64% over the course of 5 years. The higher the S&P also goes, the more collateral the firms that are shorting it are able to pledge in order to continue to short AMC into the dirt. Remember, the majority of shorts that got caught offside on AMC got caught here. It was the initial dilutions by Adam Aron that was bought by custodians to cause these 1,000 back-to-back percent runs in the January and June fractals. So simply put, macro sequence, your next major POI is the first week before the Super Bowl. We also know that that is where Adam Aron is able to begin his dilution that they agreed upon in the December shareholder meeting, authorizing AMC common stock to be diluted up to 1.1 billion shares. Now, these next periods of dilution will hit on your macro POIs. Your problem is you are hovering right above your super macro golden pocket. If you do not make a run on your February 5th POI to begin our markup sequence into our most recent macro supply zone, which is around that $3 mark, you will finish distribution all the way into your golden pocket by the end of quarter one, leading into something like April 10th. AMC has to bottom in that period of time, because if it doesn't, you are in serious jeopardy and danger of going to the OTC. Now, I don't personally believe that that's going to happen. Once we super macro bottom, we are going to stair step into that $6 mark, which we talked about over 2 years ago now in 2024. It has always been the mark. I have never once changed my price target on Twitter ever in any video, period. 6 has always been it for me. That has always been top. That is where I continue to stand. I don't care if the bottom is 1. I don't care if it's 80 cents. It does not matter. You bottom before April 10th, you mark up to $6 on a stair step, which is going to take a long period of time, all the way up to a year, year and a half. Remember, siphoning this much liquidity through this distribution pattern over the course of 3 years into HYMC is why you're not getting your 1000% move on AMC. They completely chop them up between the two tickers, as they are going to do between GME Common and GME Warrants. So let's get to that. The major difference between GameStop and AMC is very simply, you're in a reaccumulation schematic for GameStop. In AMC, you're in a distribution schematic, which is still hitting on the super macro. Reaccumulation looks like this, guys. And that's exactly where this is going. But don't think it's going there this year. This is going to take 5 to 7 years to even play out. One thing you guys have to understand about delaying macro and super macro POIs is it doesn't just extend 2 months or 6 months. Delaying super macro POIs extends up to 2 years of delayed markup price action. It is one of the most brutal things you can witness in the stock market. But again, don't overcomplicate and keep the Fibonacci sequence as it's supposed to be. Your golden pocket for this super macro sequence of 5 years total is your supply zone right here, which is coincidentally where your golden pocket is. There is such a small chance that GameStop eclipses this supply zone to actually break and go over $120. It's virtually zero. It would be incredibly unwise to listen to accounts that are telling you GameStop is going to run over 500%, 600% in this location. Play the structure as it is designed. Play it like you would play any other stock. My price target for the end of the year going into Q1 after the GME warrants on October 30th are thrown back into GME Common is simply your golden pocket. I will be taking complete profit at this zone. Common sense and functionality show you that there has not been one moment in time where GameStop has ever broke this supply zone. How many rejections do you need to see to understand that that is not how this stock behaves? This is not a squeeze stock anymore. This is a Tesla stair step type stock. Your next major move stops at your golden pocket. And who in their right mind will complain about it, guys? You're talking about a 150 to 200% move on GameStop. That's good enough. You guys should not be staring at these two tickers every single day, putting your life savings in them. These aren't those stocks anymore. You're wasting your money, you're wasting your effort. We learned enough at this point to learn how things are going to move in the future. You can take this with a sure sign of confidence that your golden pocket will be hit. And there's no logical reason to hold options past that unless you're holding shares and you want to take a ride over the course of the next 7 years. You go ahead, but that's not for me. And finally, GameStop right now does have the same macro POIs as AMC. The difference is AMC is running distribution on its super macro. GameStop has already bottomed on its super. It is going to continue to mark up from this point forward, starting on your February 5th POI. After which, it will continue to stair step throughout the Super Bowl, throughout February, into the end of the quarter. You should get to that supply zone grab at $30. And that would end this macro fractal sequence. That is where I will be taking profit. If it goes a little bit higher, great. If it goes up a little bit lower to 27, great, because this sequence ends around that April 25th to 30th mark. So now you guys have both the AMC distributive macro targets going into March. You have the GME markup macro targets going into April. You have the super macro target for AMC leading into the end of the year and Q1 of next year. And additionally, you have GameStop super macro targets in the exact same time frame. A word to the wise from someone that has hit every single macro and super macro markup sequence since November 2022. When these stocks move and the IV goes and you reach your supply zones, take profit. There are 1,000 other plays out there. Do not tunnel vision. Do not fixate and stop listening to the people telling you these stocks are going to explode off the charts. They are not designed that way anymore. BlackRock has a complete vice grip around these algorithms, which are tethered to the indexes. They are not squeezing past super macro supply anytime soon. If I see a change within the POIs, I will alert you immediately. But as for now, you have your supply targets. Make sure you are trading smart, trading efficiently, and don't over leverage because it's not worth it if things go the opposite way. Keep your family safe. If you want to get in the Discord, you know where to find me. I love you. I'll see you guys later. Enjoy the snow.